Gary DeWaal here, and this is Bridging the Week for October 20th to 24th, and today is October 27, 2014. Good morning! Promoting stronger cultures at financial services firms was the theme of a workshop held at the Federal Reserve Bank of New York this past week. Also last week, the Inspector General of the Federal Reserve System acknowledged the Federal Reserve Bank of New York's own supervisory weaknesses that caused it early on not to review trading activity in the Chief Investment Office at JP Morgan Chase that ultimately led to losses of over $6 billion by the end of 2012, the so-called London Whale incident. There was a lot going on last week, so to ensure all of us get home early this coming Friday to celebrate Halloween, let's get started. Enhancing culture was the theme at a workshop on, quote, reforming culture and behavior in the financial services industry, end of quote, last week held at the Federal Reserve Bank in New York City. In two presentations, William Dudley, President and Chief Executive Officer of the Federal Reserve Bank of New York, and Daniel Tarullo, Governor of the Board of Governors of the Federal Reserve System, urged financial institutions to modify compensation arrangements to help promote more desirable employee conduct. Mr. Dudley specifically argued that more compensation should be deferred and for longer periods, and suggested that restructuring long-term deferred compensation as debt might better align senior managers' focus with their firm's, quote, long-term enterprise value, end of quote. Likewise, Mr. Tarullo claimed that, quote, there is still considerable work to be done in developing and implementing incentive compensation arrangements that truly gives appropriate incentives to employees, end of quote. However, he also argued that sometimes poorly conceived or implemented regulations can contribute to a quote-unquote mere compliance mentality as opposed to a more meaningful culture. To me, maintaining a strong compliance culture is essential for financial services firms, and balancing incentives to promote culture no doubt plays an important part in this balancing. In the end, however, a good compliance culture is all about ensuring that every employee applies the grandmother test to every action he or she takes. Do not engage in conduct that you would not be proud to defend to your grandmother when she inquires after reading about it in the morning tabloid, especially if the morning tabloid is the New York Post. The Commodity Futures Trading Commission proposes to amend one of its rules to provide more guidance regarding the circumstances when accountants may be barred from practicing before the Commission. This proposal follows the CFTC's filing and settling an enforcement action in August 2013 against Jeannie Varaha Snelling, the external certified public accountant responsible for auditing Peregrine Financial Group's year-end financial statements from 2001 through 2011. Peregrine, you will recall, previously registered with the CFTC as a futures commission merchant, filed for bankruptcy in July 2012 after Russell Wassendorf, its owner and chief executive officer, admitted to fraud in stealing customer funds. The Office of Inspector General of the Federal Reserve System identified various supervisory breakdowns at the Federal Reserve Bank of New York that caused the Federal Reserve Bank of New York not to investigate trading activities by JP Morgan Chase & Company that ultimately caused the firm to sustain over $6 billion in losses by the end of 2012. The trading occurred in the Chief Investment Office of JP Morgan's London branch, the so-called London Whale incident. During the relevant time, the Board of Governors of the Federal Reserve System was the lead banking regulator for JP Morgan. According to the Inspector General, the Federal Reserve Bank of New York had identified risk associated with the Chief Investment Office's trading activities as part of its ongoing monitoring of the bank, and planned two limited reviews of the Chief Investment Office's activities in 2008 and 2010, as well as recommended a full scope examination in 2009. However, said the Inspector General, the Federal Reserve Bank of New York never conducted these reviews because of, quote, many supervisory demands and a lack of supervisory resources, end of quote, among other reasons. However, the Inspector General noted that it could not say whether completing any of the missed examinations, quote, would have resulted in an examination team detecting the specific control weaknesses that contributed to the Chief Investment Office losses, end of quote. 6 federal agencies adopted final rules imposing risk retention requirements on originators of certain asset-backed securities as required by the Dodd-Frank Wall Street Reform and Consumer Protection Act. As its core provision, sponsors of such securities will be required to retain at least a 5% economic interest in the credit risk of the assets underlying each issue. The rules are effective 1 year after publication in the Federal Register for residential mortgage-backed securities and 2 years for all other types of securities. J.P. Morgan was fined in 2 separate matters brought by the European Commission related to alleged violations of European Union antitrust rules. In one matter, the firm was fined 61.6 million euros for its role in a claimed bilateral cartel with the Royal Bank of Scotland, whose purpose was supposedly to influence the Swiss franc London interbank offered benchmark rate between March 2008 and 2009. In the second action, JP Morgan was fined 10.53 million euros, UBS 12.65 million euros, and Credit Suisse 9.17 million euros for their alleged roles in operating a cartel whereby they quoted among themselves narrower bid-ask spreads of Swiss franc interest rate derivatives between May and September 2007, while at the same time quoted wider spreads to others. RBS also alleged to have participated in this cartel. All the banks voluntarily settled their actions. The Commodity Futures Trading Commission staff authorized future commission merchants to credit a customer's account for a margin payment as soon as it initiates a withdrawal from the customer's bank account using the automated clearinghouse transaction system. This is an important development for FCMs to avoid having to take a capital charge for certain unmet customer margin calls, among other reasons. And finally, the Securities Industry and Financial Industry Markets Association proposed 10 principles to help encourage a partnership between financial regulators and the financial services industry to better protect the financial sector's data security and infrastructure from cyber-based attacks. As part of its rollout of these principles, SIFMA argued that coordination between regulators and industry is critical to ensure, quote, harmonization and regulatory guidance, end of quote. According to SIFMA, quote, the proliferation of different government and private sector security standards creates confusion and fosters an environment in which non-compliance is at risk, end of quote. Well, that's it for this week's Bridging the Week. As always, there is more information in each article and more articles on the article version of Bridging the Week on this website. Check it out. Until next week, this is Gary DeWaal. Have a great week and happy trick-or-treating. Ciao!